For centuries, gold has been the undisputed store of value, trusted by kings, countries, and everyday people when currencies fail. But now, a digital challenger has emerged: Bitcoin. The question echoing through finance is simple. Can Bitcoin, with just 16 years of history, ever match gold's trust and universal acceptance? With real money and institutions now in play, the stakes have never been higher. Let's dive into the brutal truth of the Bitcoin versus gold debate. Gold is a rare, beautiful metal, coveted by civilizations for thousands of years. Its unmistakable luster and resistance to tarnish have made it a symbol of wealth, power, and prestige across continents and cultures. From the earliest days of human history, gold has been more than just a shiny object. It has been a foundation for trade, a reward for conquest, and a source of inspiration for art and legend. With a 5,000-year legacy as money and a store of value, gold's story is woven into the fabric of human civilization. Empires have risen and fallen with gold at their core, and its allure has sparked exploration, innovation, and even conflict. Gold coins have crossed deserts and oceans, serving as a universal language of trust and value. Its worth is inherent, not dependent on any government or company. Gold's value is recognized everywhere, regardless of borders or politics. It is tangible, finite, and cannot be created at will, making it a reliable anchor in times of uncertainty. In contrast, Bitcoin, created in 2009, is digital, decentralized, and capped at 21 million coins. It exists only in cyberspace, secured by cryptography, and maintained by a global network of computers. Bitcoin was designed to be independent of banks and governments, offering a new vision for money in the digital age. Both assets are seen as hedges against inflation and currency debasement. Investors turn to gold and Bitcoin when they fear that paper money will lose its value. Each offers a different kind of protection. Gold with its physical presence and ancient reputation. Bitcoin with its digital scarcity and borderless nature. Gold's track record is its greatest strength, proven through wars and crises, universally accepted. It has survived the collapse of empires, hyperinflation, and financial panics. In every era, people have trusted gold to hold its value when all else fails. Bitcoin, still young, is evolving and untested in true global catastrophe. Its price can swing wildly, and its long-term resilience remains a question. Yet, its rapid adoption and passionate community suggest it could become a new pillar of value for the digital generation. This difference in history is the core of the debate. Gold, the ancient king, offers the comfort of centuries. Bitcoin, the digital upstart, promises innovation and possibility. The world now watches as these two assets, one forged in the earth, the other born in code, compete and coexist in the search for lasting value. Let's look at the numbers for 2025. Bitcoin trades around $123,000, up 78% in a year, but with wild swings, dropping from $126,000 to $76,000 in months. Gold, at $3,630 an ounce, is up 43%, a steady, less stressful climb. Bitcoin offers astronomical returns but extreme volatility. Gold's gains are measured, but it provides stability and peace of mind. Investors must choose explosive growth or steady protection. Gold's appeal endures, especially as central banks buy record amounts. This precious metal has been a cornerstone of financial stability for centuries, and its allure only grows stronger in times of economic uncertainty. Central banks around the world are increasing their gold reserves, a clear indication of gold's enduring value. To reduce reliance on the US dollar, countries like China, India, and Russia are leading this charge. This de-dollarization trend is a strategic shift, not speculation. By diversifying their reserves, these nations aim to protect their economies from the volatility associated with the dollar. Gold is a neutral reserve asset, trusted in times of uncertainty. Unlike fiat currencies, which can be subject to inflation and political instability, gold maintains its value. It is a tangible asset that does not rely on any government or financial system, making it a safe bet in turbulent times. Its role as a hedge against chaos is deeply ingrained. Gold is the ultimate insurance policy. Investors flock to gold during market downturns and geopolitical crises, knowing that it will hold its value when other assets falter. Unlike Bitcoin, gold's price often moves opposite to stocks, reinforcing its safe haven status. When stock markets crash, gold prices typically rise, providing a counterbalance to the losses in other parts of an investment portfolio. Bitcoin, meanwhile, still behaves like a risk asset, often falling with markets. Despite its growing popularity, Bitcoin has not yet proven itself as a reliable store of value in the same way that gold has. That's why, despite the hype, institutions still trust physical gold. Financial professionals and institutional investors continue to favor gold for its stability and historical performance. They recognize that gold's intrinsic value and physical presence make it a dependable asset. Its stability is its most valuable feature. In a world of financial uncertainty and market volatility, gold remains a steadfast pillar of security. Its enduring value and reliability ensure that it will continue to wear the crown of stability for years to come. For Bitcoin, 2025's story is Wall Street's embrace, thanks to US spot Bitcoin ETFs. Institutional giants like BlackRock and Fidelity have poured in, legitimizing Bitcoin. 75% of institutions plan to increase digital asset exposure this year. Bitcoin's cap supply, just 21 million coins, plus the 2024 halving, is fueling a supply squeeze. Investors are moving coins off exchanges, tightening supply further. A pro-crypto US administration has boosted confidence and reduced regulatory fears. Bitcoin's appeal, a finite, programmable alternative to endlessly printed fiat. Gold's total market cap is over $13 trillion, a fortress built over millennia. Bitcoin at $2.5 trillion is less than 20% of gold's size. For Bitcoin to match gold, its price would need to exceed $600,000. Gold's massive size brings stability. It takes huge sums to move its price. Bitcoin's smaller market means big price swings from relatively small capital flows. There's huge growth potential, but also greater risk and immaturity. Bitcoin has a long way to go before it rivals gold's depth and stability. Bitcoin's biggest risk is volatility. Massive gains can be wiped out in weeks. Gold's trust is built on physical reality. Bitcoin's on cryptography and code. Lose your Bitcoin keys and your funds are gone forever. No recourse. Security breaches and hacks are a constant threat for Bitcoin holders. Regulatory risk looms. New laws or bans could crash Bitcoin's price overnight. Gold, by contrast, is fully regulated and universally accepted. Bitcoin is riskier by almost every measure: complex, volatile, and uncertain. Gold protects wealth. Bitcoin is a high-risk, high-reward bet. For a time, Bitcoin and gold moved together as hedges against currency debasement, but in early 2025, the great decoupling hit. Gold rose as a safe haven, while Bitcoin fell with risk assets. Gold's price is driven by macro factors: central banks, geopolitics, real rates. Bitcoin is still treated like a high-growth tech play, swayed by sentiment and regulation. In crisis, both may rise, but they serve different roles. Gold is defense, steady and reliable. Bitcoin is offense, speculative, with explosive upside. Will Bitcoin ever catch up to gold? This question has been on the minds of investors, economists, and tech enthusiasts alike. Bitcoin, often referred to as digital gold, has seen a meteoric rise in value and popularity over the past decade. But can it truly rival the age-old stability and trust that gold has built over millennia? The brutal truth: it's unlikely anytime soon, maybe ever. Gold has been a reliable store of value for over 5,000 years, weathering economic storms, wars, and technological changes. Its physical presence and intrinsic value make it a safe haven in times of uncertainty. Gold's $13 trillion cap and 5,000-year history are a deep moat. This vast market capitalization and historical significance provide a level of security and trust that is hard to replicate. Gold has been used in jewelry, currency, and as a standard for global trade, embedding itself deeply into the fabric of human civilization. Bitcoin, though, is carving out its own niche as digital, non-sovereign value. Unlike gold, Bitcoin is decentralized and operates on a peer-to-peer network, free from government control. This makes it an attractive option for those looking to hedge against inflation and currency devaluation. Institutional adoption is real. If big funds allocate even a little, Bitcoin's price could soar. Major financial institutions and corporations are beginning to recognize Bitcoin's potential, adding it to their portfolios and balance sheets. This institutional interest lends credibility and could drive significant price appreciation. The smartest move isn't choosing one, but understanding their roles. Gold, for stability. Bitcoin, for growth. Diversification is key in any investment strategy. While gold provides a stable foundation, Bitcoin offers the potential for high returns, albeit with higher risk. Balancing both can provide a more resilient portfolio. Bitcoin has already forced the world to rethink money. Gold remains the foundation, a symbol of enduring value and trust. However, Bitcoin's rise has sparked a revolution in how we perceive and use money, challenging traditional financial systems and introducing the concept of digital scarcity. But Bitcoin is now the most powerful contender. Its technological backbone, the blockchain, ensures transparency and security, making it a formidable alternative to traditional assets. And ignoring it would be a mistake. As the financial landscape evolves, staying informed and adaptable is crucial. Bitcoin and gold each have their unique advantages, and understanding both can help navigate the complexities of modern investing.